of news from OpenAI. We are joined by Alex Heath. Alex is the author of the Sources newsletter and co-host of the new Access podcast from Vox Media. He is joining us just after actually attending OpenAI's Dev Day event. Alex, thank you for joining us on Prof G Markets.
Thanks for having me. Fan of the show.
I'm glad to hear it. So you were just at Dev Day, the annual developers conference for OpenAI. What did we learn? What were your takeaways?
I would say the big takeaway is ChatGPT wants to be your operating system. They want to have all kinds of apps inside the experience. They demoed Figma, Coursera, Zillow. They're going to onboard a lot of developers where essentially you don't have to leave ChatGPT. It creates these rich visual apps inside the chatbot for all kinds of third-party websites and apps. So that's a pretty big vision. Then they showed this agent workflow tool where basically you can no-code create an agent from scratch. They did it on stage live in under 8 minutes, made an agent. I thought that was kind of fun. And otherwise, I would say, they're still very much riding high from that recent release of Sora, the Sora app, and they're releasing that same video technology for developers. So essentially, what you see in that Sora app, third-party developers will now be able to put into their products through the API.
What was the feeling among developers at the conference? Did people walk away feeling pretty excited? Was it kind of a meh? How did people feel about this?
I think if you're a hardcore developer, nothing here really blew you away. It's more iterative. I think the opportunity to get distribution through ChatGPT as a third-party app developer is very exciting for people. That's the thing I heard a lot. Kind of reminds me of the early App Store when there was just this gold rush of indie mobile apps popping up everywhere. I mean, ChatGPT just hit 800 million weekly users, so that's about 1/10 of the global population. It's a tremendous distribution service. It's crazy, and this is a product that's like 3 years old. So that seems like a pretty big deal, and they're going to figure out some kind of revenue share model where they were very vague about it, but it sounds like the developers will maybe pay OpenAI for visibility or vice versa. I don't know. They were not clear about it, but it sounds like there's going to be some kind of app store-like revenue model here that they're going to do, which could be big for them because they need money, as everyone knows, to fund all their aggressive compute build-outs with Stargate. So a lot happening. I mean, man, just OpenAI seems so ascendant. They seem almost untouchable in terms of the velocity of what they're shipping right now.
You also spoke with Greg Brockman, who is the president of OpenAI. What did he have to say? What were his takeaways?
Yeah, I talked to Greg for about 30 minutes about mostly Stargate. So he's running Stargate now with Sam Altman. And, the theme you heard here with, my convo with Greg, and then there was a media Q&A with Sam and some of the other execs that I attended, is that they are compute constrained. They are capacity constrained. On what the products that they have, and then also the products that they want to put out. There was that new Pulse feature that I think is gated to the $200 a month ChatGPT tier, where essentially ChatGPT will start recommending things to you agentically, things like a calendar reminder or saying, looking at your inbox and saying, here's what you should do today, here's what you should follow up on. That kind of stuff that requires the more expensive reasoning models is very expensive for them to run at scale. And so they're limited in what they can do. That's why that feature's still gated at $200 a month. And I think they want to release a web browser. I think they wish that they could open the Sora app to everyone and not have it be invite only. That's another thing that's gated by compute. So they seem to think they can 10x their compute from here and just still be serving the user base that they have. So I think that's what's motivating a lot of this build out. And I do think there's competition at play. I do think there's also the Mag 7 hyperscalers going out there and buying up a bunch of GPUs and capacity as well. And it's like this gold rush and, frenzied just rush to try to secure as much capacity as possible. It seems like this is the new oil.
Yeah, I want to return to the compute question in a second, especially in light of this AMD news. But just one final question about Dev Day itself. Johnny Ive was a big feature at Dev Day. He is, of course, the designer behind the iPod and the iPhone. He is reportedly working on a device for OpenAI. Did we learn anything about that device? Did he tell us anything new at Dev Day?
No, they're super cagey about the device. We know that it won't be a phone. It won't be glasses. what I've heard and what the other reporting suggests is that it's kind of like a puck that you hold that has a bunch of sensors on it, basically feeds ChatGPT data from the world around you and gives it more context about your life. A fun thing I heard recently from sources is that Johnny Ive is like considered, how can we position this almost like the Walkman, like a cool thing that people wear around them, wear on their hip or whatever and walk around with, and is taking in the outside world for them. So it's going to be this more passive, always listening on device. At least that's the thing they're currently working on, to my understanding.
Got it. Just returning to the compute question, this AMD deal, which is arguably bigger news than Dev Day itself. This new deal between OpenAI and AMD. OpenAI is going to take a 10% stake in AMD. Part of this partnership means they're going to buy 6 gigawatts of compute capacity. They didn't mention how much it'll actually cost, but they said tens of billions of dollars. I've seen stuff that suggests that this is going to cost a lot more than that. Your reactions to the AMD deal and what it says about the compute path ahead for OpenAI?
Yeah, I asked Greg Brockman about that because he, obviously worked on that deal with Lisa Su from AMD, and he acted like it was the first deal of its kind with that structure, and that they'll probably do more of them. That they're probably going to be more bespoke, kind of tranched out deals, maybe in return for equity, rev share, et cetera. It sounds very bespoke based on the need of the partner. Because, the NVIDIA deal was structured very differently, right? There was no like OpenAI getting equity in NVIDIA, right? It was the reverse. So I think it's dependent on the partner, but they're willing to do whatever it takes to shore up more compute. And so I think they're talking to everybody at every layer of the stack, from power cables, all the way up to, just the GPUs themselves. But it sounds like there are going to be a lot more, and that we're going to hear about this financing instrument, a way to kind of standardize and templatize this, that Sam Altman's really pushing for. It still sounds months away, but it sounds like they're thinking about how can we create a blueprint for this that we can use to scale up into the hundreds of billions, I think is what they're thinking. The numbers they're astonishing. I mean, it's hard to comprehend, but they clearly see something on the other side. I don't think they're totally irrational. I think they're very excited, maybe a little irrational, but I don't think they're totally irrational.
Do you have any concerns about this idea of the circular deal that we keep seeing? This idea that, NVIDIA invests in OpenAI, and then OpenAI goes and buys the NVIDIA compute capacity, and we see similar things with Oracle. We're seeing a similar thing again here with AMD, with this strange arrangement. A lot of people say this is what happened in '99. There are concerns that, where is the real revenue actually coming from? Are we just printing money? Do you have any concerns about that yourself?
I do. I definitely do. I mean, ChatGPT is at a 10 plus billion annual run rate. There's no reason to suggest they couldn't keep scaling that. I actually think there's maybe more of a limit on a subscription business than people realize. In India, for example, where ChatGPT is rapidly approaching its largest market, if not already, they're doing a lower price subscription because you can't really scale at 20 a month in India like you can in the US. So the margin profile starts to look a little different on subscriptions the bigger you get once you get into the billions of users. The only models, and we know this based on history, that really monetize effectively at billions of users, the only model is ads. So they have to do ads. I know they're going to do it. I know they're thinking about it. It's just a matter of when and how. And I think where it shows up, does it show up in the Sora app first? Because it's like a TikTok-like experience, maybe. Does it show up in Pulse, that new ChatGPT feature? Maybe. I think they're thinking hard about it right now. In the media Q&A, I asked Altman about that, and he was like, well, I like Instagram ads. If we can do something as good as Instagram ads, I mean, who's to say? And this is a huge change. I mean, OpenAI leaders, I remember even almost a year ago, the idea of ads was like they would never even consider it. So they know they have to monetize. I think that would be the way that they could get to tens of more billions in ARR. Which could, it could pay for more of this. At the end of the day, there still is the math doesn't quite work out, right? Like, it's like, what are we really building towards here?
Yeah, I'm glad you mentioned advertising, and I'm glad you asked Sam that question. That's my big question. What are you going to do about the advertising? It sounds like they didn't really mention it, and then when you did ask it, he was kind of cagey about it, or at least didn't give you much of an answer to what seems to be the $1 trillion question. Is that the vibe you got from Sam Altman?
Yeah, they're being cagey about it. I mean, right now they get to say that ChatGPT's business model is inherently aligned with the user because there are no incentives for them to recommend you something that you don't want to see, right? Because you're just paying a subscription. It's this almost like moral virtue in the product that they're very proud of. I think they're very wary of introducing different incentives with an advertiser in the middle and how they do that, and they want to be thoughtful about it. So that makes sense to me, but they have to do it. I mean, they can't monetize the user base at the billions. And you look at who they're bringing in, Fiji Simo, the executive team she's filling out, they're all OG Facebook people that scaled Facebook from, single digit billions to tens of billions a year in ad revenue. So it's a tale as old as time. I mean, you try to ignore ads until you can't. And with how capital intensive their business is, it's the most capital intensive business I think that's ever existed. They can't do it on subscriptions alone. And this Johnny Ive hardware stuff is, who knows how that will materialize. So I do think it's the opportunity. I would be shocked, Ed, if we're not talking a year from now and there are not ads in ChatGPT.
All right. Alex Heath, author of the Sources newsletter, co-host of the Access podcast, which is a great podcast. You've been getting some wonderful guests, and you recently launched that. So shout out Access Podcast. And Alex, we really appreciate your time. Thank you for joining us.
Thanks, Ed.
Okay, so this AMD deal. We've been talking a lot about these circular deals that have been happening in AI recently. NVIDIA investing billions in OpenAI, and then OpenAI using the money to buy compute back from NVIDIA, but also using it to buy compute from Oracle, which Oracle then uses to go buy more chips from NVIDIA, et cetera, et cetera. This is the circular deal theory. My revenue is your revenue, is my revenue is your revenue, and so on. The money goes around in a circle, and with every deal announcement that we see, we also see this big bump in the stock. This is the exact same thing. So essentially what happened here is OpenAI goes to AMD, and they say, we want to buy 6 gigawatts of power, to which AMD says, great, okay, that is going to cost you about $200 billion. To which OpenAI says, great, we don't have that money right now, but let us get some of your stock. And then when we announce the deal, the stock is going to go up in price, and we can use that to finance this transaction. And then AMD says, well, that's a little weird, but okay, what should we do if the appreciated value of the stock doesn't cover the price of the contract? To which OpenAI says, we'll figure that out later. And then they say, okay, they shake hands, they announce the deal, and then AMD stock skyrockets up 25%, and everyone's pretty much happy. That is essentially what has happened here. Now, to be clear, I said it would cost $200 billion, but we don't actually know the real price. The real price hasn't been disclosed. That $200 billion number, that was an estimate. Because according to executives at OpenAI and according to many other experts in the industry, according to them, 1 gigawatt worth of chips, 1 gigawatt worth of chip compute capacity, that costs about $35 billion. Now, that doesn't include all of the other costs like the land and the energy and the construction costs, all of the things that are required to actually get those chips online. That's another $15 billion. But for the sake of simplicity, we're just going to focus on the chips now, and we're going to assume $35 billion per gigawatt. That's what people in the industry say. So 6 gigawatts of power, that is around $200 billion. Now, the official announcement here said that this was going to cost, quote, tens of billions of dollars, which is a lot lower than is realistic. And it's also very vague. Tens of billions of dollars kind of implies below $100 billion, but it doesn't really tell us anything. I mean, how many tens of billions of dollars? That is crucial information that they are omitting here. However, you also have to remember that this is really by design. Because what OpenAI wants you to ignore, and this goes back to our conversation with Alex there, what they want you to ignore with this deal is how unbelievably expensive it is. And how when you actually add up the numbers of all of these contracts, suddenly the numbers cease to make sense. So let's do what OpenAI doesn't want us to do. Let's add up the numbers, and you can decide for yourself if it makes any sense. So we will start with AMD, which, if we're going off of market pricing, again, will cost OpenAI a little over $200 billion. Next up, we have NVIDIA. They have this partnership with OpenAI, which is going to be 10 gigawatts of capacity. So that's going to cost OpenAI roughly $350 billion. Then you have this deal with CoreWeave, which has been expanded twice, and that's about $22 billion. And then there's also Oracle, which is going to be about $300 billion. That is the future expectation of costs for OpenAI. Lastly, we have this deal with Broadcom, and that's going to be $10 billion. So, in total, OpenAI plans to spend over the next few years $882 billion. That is more than the US government will spend this year on education, transportation, agriculture, the Department of Justice, the Department of Labor, the Department of Homeland Security combined. It is also more than the total free cash flow that Microsoft has generated over the past 20 years. Now, the very obvious question here, how on earth are they going to pay for this? Well, if they were a profitable company, you would say they are going to pay for it with their profits. They're going to pay for it with the cash that they are bringing in the door. But this brings us to the other glaring issue here, and that is OpenAI isn't profitable. It is unprofitable, in fact, extremely unprofitable. Just to go through the numbers here, they did more than $4 billion in revenue in the first half of the year, but they posted a net loss of nearly $14 billion. You look at their cash burn, which is on a current trajectory of $10 billion per year. Part of the problem is how much they're spending, but also there's the fact that they signed this deal with Microsoft where they have to hand over a fifth of their revenues over to Microsoft. So actually, in addition to all of these contracts, we also need to factor in their burn, the amount that they're spending on marketing and R&D and compensation, etc., which over the next few years should add up to between $50 and $100 billion. Now, to be clear, OpenAI says their burn is actually going to increase significantly from what it is today, but we're going to lowball it. We'll call it $50 billion over the next few years. So we are now up to $930 billion in gross spend. Again, how do you pay for this? Let's do the math. Supposedly, OpenAI has about $18 billion in cash on their balance sheet. Okay, strong balance sheet. With the AMD deal, assuming the stock is issued and it stays elevated, they're going to have another $30 billion worth of AMD stock. Then you've also got the NVIDIA deal, which again, isn't signed, isn't completed, still highly contingent on multiple factors, but let's assume it happens as planned. Then they're going to have another $100 billion in cash that came from NVIDIA. Add that all up. That's $150 billion. That's how much cash they will presumably have. The spending plan is $930 billion. So we are short $780 billion. That is $280 billion more than the current valuation of the entire company. So that means if they want to do all these things they say they're going to do, they have to sell either $780 billion worth of equity, which is impossible, or they have to sell $780 billion worth of debt. More possible, but still close to impossible. This is getting crazy. Gil Luria, head of tech research at D.A. Davidson, he said it best on the podcast just a few weeks ago. He said they are making a lot of commitments and they don't have the capital to fulfill those commitments. He is right. I'm sorry. OpenAI does not have $780 billion, nor will they have $780 billion within the time frame they are suggesting here. Now, why does this matter? Why do I care? Why do we care? Why should you care? OpenAI is a private company after all. We've talked about that a lot. It should only really impact a handful of investors if things go wrong. The trouble, however, is the impact that OpenAI now has on the public stock market, on stocks like NVIDIA and Oracle, and in this case, AMD. It's the fact that the company actually can just say things, announce deals, and it does drive stocks up to the tune of tens of billions of dollars. In the case of AMD yesterday, $100 billion. So the stock market is at this point inextricably linked to OpenAI. And so when you realize that the prospect of OpenAI not fulfilling its promises, when you realize that isn't just probable, it's actually likely. In some cases, some would say it's actually certain. Well, then suddenly you have to ask yourself, what comes next. What happens to AMD stock if OpenAI can't make good on this contract? What happens to NVIDIA? What happens to the rest of the S&P 500 for which AI is driving 75% of the returns? These are the questions we need to start thinking about. These are the questions we need to start taking seriously. And no, that doesn't mean sell. We're not there yet. It just means pay attention. When you see these AI headlines, when you see these stocks ripping up 25% just on some deal announcement, you need to ask yourself, what is really going on here? What are they really saying? What do they want us to believe? Don't let FOMO get the better. Will also take over as the new editor-in-chief of CBS News. She will report directly to David Ellison, and she will take the reins of flagship programs such as 60 Minutes. As a reminder, Bari Weiss is a former New York Times journalist who resigned in 2020, citing a, quote, illiberal and hostile work environment. She launched the Free Press in 2021 as an alternative to mainstream media. So here we are 4 years later, and Weiss is stepping back inside the mainstream tent. This time she's bringing a readership of 1.5 million Free Press subscribers, with her 170,000 of whom who are paying subscribers. The Financial Times estimated the Free Press generates more than $15 million per year. So that $150 million price tag would value the platform at 10 times revenues, which feels rich. By comparison, Netflix's revenue multiple is 12 times. So for more on what this acquisition means for the future of independent media, let's give Scott Galloway a call. Scott, how's it going?
It's going really well, Ed. I just did a workout with my son, and he is now officially stronger than me, so I am cutting him off.
No way. I don't believe it. Wow. I actually do not believe it.
He's faster.
Wow.
And more agile than me. Okay. I'm still stronger, but I'm freakishly strong, Ed. I'm freakishly strong. I mean, look at these weights. See, if you buy all these weights, you're going to be just really fucking strong, even if nobody ever touches them.
We need to get you to start working out during the podcast. I think that could be an interesting new spin on things.
Well, hold on. Let me do my impression of a Kash Patel pull-up. Okay, this is a Kash Patel pull-up. 1, 2, 3, 4, 5, 6, 7. This is how the dog does pull-ups. That's right, Dick. That's right, ladies. Surrender to the dog. Secretary of War, ass.
This is independent media at its finest. You're not seeing this on TV. This is our differentiator.
I could have a stroke right now, Ed. I could have a stroke.
All right. Speaking of independent media, we want to get your reaction to the Paramount CBS News Free Press deal, which officially closed. They officially announced Bari Weiss as the new editor-in-chief of CBS News. They're acquiring the Free Press for $150 million, 10 times revenue. Scott, your initial reactions?
My initial reaction, Ed, we're going to be rich. if that thing sold for $150 million. No, look, okay. My first reactions. I'm happy for Bari and I'm happy for independent media. I know Bari, it's only 4 years old. And I don't know her well, but I've had lunch with her and I think she's smart. I think she's fearless. I think she built a really nice company and I'm happy for her and her family and the journalists at Free Press. The genius was that there was very few reputable media companies kind of right of center. It kind of went full spectrum, center, left of far left of center, and then it went all the way to kind of the crazy shit in Fox and Daily Wire. Very few things kind of right of center. They occupied that space. The second thing is, I think the majority of her revenue when I met with her was subscription. And that is very attractive because those revenues are much more enduring, right? Mm-hmm. In addition, I think they were probably excited to have someone who they saw as fearless and right of center kind of take charge of the CBS newsroom. Now, the other thing is she's about to have the worst fucking job in the world because all she's going to do is be the person jumping on the grenade of massive layoffs and basically the neutering of the CBS newsroom. And from what I understand, it's already been pretty seriously neutered. But the reality is, if you look at the NBC, CBS, and ABC nightly news, it's the same fucking thing. It's 22 minutes of them reporting the same goddamn story, and then a feel-good story about a woman in Alaska who's been feeding a big cute bear for 30 years that continues to show up at her door. It's 22 minutes of them saying the exact same thing.
That's a good story, man.
About the exact same stuff. And then a feel-good story about, a porpoise that saved a dog's life. And now the porpoise comes back to say hello to the dog every day. It's just, it's the same fucking thing. And the reality is these companies, they get 6 to 7 million viewers a night. It's gone way down. And the core demographic is people aged 25 to 54, the people that advertisers care about, just aren't watching these shows any longer. What you hope is that occasionally, not even a lot with these programs, occasionally they have a clip that goes viral. And all she's going to be doing is essentially explaining, sending out memos and meeting with journalists who are going to think she's the devil. Because the other observation I have is that in the world of the economy, this is a meaningless acquisition. There have been 5 acquisitions in the last week of $8 billion, of 50 times this size. There was a merger between 2 railroad companies that I think totaled 80 billion, or 500 times the size of this. Media is obsessed with itself. And the notion that something's going to happen to a newsroom, these folks think they're precious. I get that. They play a very important role. But the reality is investigative journalism or any type of cable news or broadcast news is no longer economically viable when the only people that advertisers want to reach are getting 2/3 of their news from social media.
Just going back to your point that it isn't economically significant, I think that is true. I think the reason people are so interested in it is because it is so culturally significant. I mean, people on the left generally are not very excited about this. People on the right generally are excited about this. But I want to read you a tweet from Paul Graham, who's the legendary investor, founder of Y Combinator, who commented on this deal, specifically on the price, $150 million. He said, "Surely this is an anomaly. They got bought as part of a plan to control the US media, not for their revenue growth." In other words, 10 times sales for the free press for a company that, as you say, media is not the greatest business, economically speaking. But his view is that this is part of a larger strategy for the Ellisons to control media, and that's why they're paying this premium.
I don't see how buying the free press is going to help the Ellisons control media. What's going to help the Ellisons control media is spending $30 or $40 billion to buy Time Warner, which includes Warner and CNN, and to control TikTok. And the notion that somehow Bari Weiss is going to come in, as talented as she is, and reshape the editorial view of all these things, it's just sort of laughable. If you want to deal with a disagreeable group of people who are under the impression they don't have a boss, walk into a newsroom. I was on the board of the New York Times. I don't know if you knew that or not. I used to, do you want to see me do pull-ups? Do you want to see me do pull-ups? I went to something called a page one meeting where they argue over which story is going to be the lead above the fold in the page one the next day. And everybody goes around and says, oh, Hillary Clinton's in Africa, or NAFTA just went through. And then they all let the sports guy go so everyone can just laugh at him. And because these are all the people that were beaten up by the athletes and they want nothing to do with sports. They just roll their eyes when this guy's talking about sports. Essentially, these folks are really good at what they do. They think that they play a special role in society. And the notion that a 30-something-year-old woman's going to come in and go, okay, we need to change our complexion to center right. Yeah, good luck with that. And she'll have the power of the purse and be able to hire and fire. But this isn't... I don't think it's going to change much. And from what I understand, the CBS newsroom is already has kind of been devastated. In addition, just the dynamics of M&A are that big companies are always hoping they're going to acquire a small company, and the competence of that small company is going to infect or save the corpus of the larger organism. And what you generally find is the larger organism always wins. And so the notion that this huge media company or a larger media company is going to be, quite frankly, is going to all of a sudden shift political viewpoint and shift culture, there's going to be massive organ rejection. Now, that's not to say she won't have influence. That's not to say that, they might have a different, a decent amount of influence. But quite frankly, this is a win for her. This shows that there is a life for independent media, subscription revenue. But if I had to bet on the CBS newsroom, and if they get a hold of CNN, and if they get a hold of TikTok, my guess is in 24 to 36 months, Barry Weiss decides to go spend some of that money and spend more time with her kids. She's going to be a very talented bug slapping up against the windshield of a newsroom of baby boomer journalists who don't really give a flying fuck what she tells them to do. But anyway, I'm being redundant here. I'm happy for Barry. I'm happy for independent media. And Ed, let's just hope that these big legacy media companies keep paying 10 times revenues.
Keep it up. Keep it up.
Because you need to get out there and get a dog. Dogs are expensive. You're living with someone.
That's right. And I'm not going to pick one up for the shelter, as we discussed. I'm going to buy one fresh.
Those are fighting words, Ed. You're getting a rescue, bitch. You are getting a rescue. And when I say you're getting a rescue, bitch, I'm meaning you're getting a rescue female dog and you're getting a rescue, bitch. That's good.
That's good. Okay.
That's good.
Appreciate your time, Scott.
All right, my brother.
Well, as we discussed, this is less of a story of economic significance and more of a story of cultural significance. The big question that everyone's asking, the reason people care about this, is because there is this question over what is the editorial direction of CBS News going to be? Could it be that now that they have acquired the free press, now that Barry Weiss is in charge, could it be that they are going to skew more towards the right? And what would that mean for the media ecosystem? Well, Scott has made his opinion quite clear. He believes that it's not really going to change anything. He believes that these companies and these outlets are too big already. Barry Weiss might want to shake things up, but ultimately she's not going to have that much of an impact. We want to get your reactions. What do you think this is going to do to the editorial direction at CBS News? How will this change?
It infuriated President Trump when he claimed to have solved hostilities between Pakistan and India, which were a reaction to a terrorist attack up in Kashmir. India refused to give him credit for bringing about any kind of peace. On the other hand, with Pakistan, the Pakistan authorities said, yes, President Trump had caused a cessation of hostilities and restoration of relatively peaceful relations, and even nominated him for a Nobel Peace Prize. So President Trump, I don't think, took that kindly.
Could we see India retaliate with tariffs on the U.S., or does India risk too much by escalating?
Well, I think India is going to have its tendencies toward protectionism exacerbated. For years and years, we've tried to bring India into a world trading system which recognizes the advantages of having goods and services move across national borders. This was not the orientation of India to start with Nehru and the whole Swadeshi, which means self-reliance movement, has been a very strong element of Indian politics from the very first. And so what this does is play right into that protectionist view. And it gives domestic political strength to those who say, yeah, we told you so. India can't rely on anybody but itself. And those people who will sell it whatever it wants without any restrictions on the arms side, that's one of the very bad consequences of this.
When you look at the economic consequence, I'm seeing forecasts that if these tariffs hold, it could knock off a percentage of GDP for India. Do you think that that is a fair assessment? And really, just what does that say about how important America is to India's economy?
Yes, I think that it is significant. And when you're talking about 1.4 billion people, and you knock off a percentage even in growth, you're affecting vast numbers of people, and you're affecting people really in areas which are most important to the United States. Cooperation in regard to manufacturing, into supply chains, into parts, those things for automobiles and trucks. Those are the things which get hurt even more, rather than, if you will, the agricultural economy, which sustains so many people. So it's very significant, and it's a lot more significant to India than it is to the United States. And that's one of the reasons I think that President Trump and his advisors, Peter Navarro and so forth, are picking on India, because India is a relatively soft target as opposed to China. And so the approach of the transactional, make a very large demand to create chaos and fear works better with India than it does with China and does others. So I think that's an aspect of it, but it's serious.
That's a great point. I'm glad you made it. Thank you so much for doing this, Raymond. I really appreciate your time.
Okay, thank you for having me.
That was Raymond Vickery, Senior Associate at the Center for Strategic and International Studies. So several months ago, Scott and I discussed what the net effect of this tariff policy would be. And our conclusion was that we would see a lot of deals would get done. They just wouldn't really involve us. We're basically sending every other nation into each other's arms. We are rerouting all of these trade partnerships throughout the world, reestablishing these geopolitical alliances for everyone else, but not for us. And it does appear that that is exactly what is happening here with India. It appears that that is what is happening with the fastest growing economy in the world. They're getting cozy with basically everyone else. They're getting cozy with Russia. Modi is chatting with Putin. He's just called Putin his friend. And they've now agreed to up their trade by 50% to $100 billion. He's been on this BRICS tour. Last month, he was hanging out in Brazil. He was also hanging out with the president of South Africa. And what is on Prime Minister Modi's agenda for next week? He's off to visit Xi Jinping in China. So yes, Beijing and New Delhi, China and India, they are now patching up their relationship. It's new as of this year. And by the way, Hollywood. This was all part of the Film and Television Tax Credit Program. It was essentially designed to bring Hollywood back to life. Well, we have an update. As of yesterday morning, according to the California state government, 22 new TV shows have been approved for production in the state of California, and those shows will benefit from the tax breaks. According to the California state press release, the expansion of the program is, quote, historic, and it will generate roughly $1 billion in wages and spending across the Golden State. Applications for subsidies have risen 400% from last year, and all eligible shows were approved. So, Hollywood is back, or at least it's back according to the state of California. 22 new TV shows, $1 billion in spending across the state, 6,500 jobs. It sounds pretty good. Maybe this isn't the end of Hollywood, but as we like to do at Prof G, let's just put those numbers into perspective for a moment. So you've got 22 new TV shows. Sounds good. And then you compare it to the 1,200 TV shows that were produced in America in 2024. Okay, you've got 6,500 new jobs, which sounds like a big deal. Okay, until you realize that the amount of jobs that LA is losing, it's been roughly 18,000 in just the past 2 years alone. So, production isn't really back here. They're basically just clawing back a third of the losses that have happened over the past 2 years. And then you have that $1 billion number, which the press release appears very proud of. Again, maybe it sounds good, $1 billion. But then you just compare it to how much is being spent and made, not in the Hollywood economy, but in the digital economy, in the world of TikTok and Instagram and YouTube. In fact, $1 billion is only a little bit more than the amount of money Mr. Beast is projected to spend on his YouTube videos in 2025. It's also the amount that Netflix spends on content every 3 weeks. So meanwhile, in addition to what digital media is doing to Hollywood, it's doing a number on it, you've also got this international competition that's happening too. It costs $53,000 to hire one grip in Los Angeles, California. In Budapest, Hungary, you can hire 6 grips for $51,000. And by the way, that is why Netflix now spends the majority of its content budget abroad. It's also why America has dropped to number 4 in the world rankings for film and TV production activity. So, no, this isn't a big deal. This isn't historic. And I'm sorry to say it, but Hollywood isn't back. Maybe the tax breaks will get you a couple extra Hulu shoots in Burbank, but the damage has already been done. Production in LA is down by a third. The average unemployment rate in film and TV right now is 11%. It has doubled in the past 2 years. So what you're dealing with here is the decline of an industry that is structural. It's not cyclical. And you're not going to fix it with tax incentives. Hollywood is dying. And, you can appreciate the efforts that the California government is trying to make here, but you can't bring a corpse back to life with a tax break. You've got to move on to other things. You've got to recognize that the entertainment industry isn't happening on the production set anymore. It's happening in people's homes, in people's living rooms. It's happening in front of an iPhone camera attached to a tripod. It's happening in front of a webcam on a live stream. We are beyond incentives at this point. We're beyond tax breaks. The future has arrived. So we appreciate the effort, California. And yes, we all miss Hollywood. Who doesn't love a classic movie? It was fun while it lasted. But let's be real with ourselves. Hollywood is not back. Trump raised the total levy on India to 50% yesterday. He also said he would impose a 100% tariff on chip imports, but companies moving production back to the US, or promising to do so, Apple, those ones will be exempt. Okay, what else is happening? OpenAI is in talks for a potential share sale that would value it at $500 billion. It is a massive jump from the $300 billion valuation it secured earlier this year. And this new deal would be a secondary sale with current and former employees selling shares. So OpenAI has hit a $500 billion valuation. That makes it the most valuable private company in the world, also the most valuable private company of all time. Well, if this isn't proof that the public markets and the IPO is just becoming increasingly irrelevant, I don't know what is. And the fact that there is enough money in the private markets to invest in a company at $500 billion, the fact that there is enough private investor demand, not for a proper funding round, but for a multi-billion-dollar secondary sale, that is evidence to me that the public markets are just kind of irrelevant at this point. I mean, think about why the public markets even exist. I mean, it's for one, to raise capital. If you want to raise tens of billions of dollars, you need to find the money somewhere. The public markets are supposed to provide that for you. 2, brand awareness, helps get your name out, helps when you're ringing the bell on CNBC, everyone's talking about you. And 3, most importantly, liquidity. If you're a founder, if you're an employee, if you're an early investor, this is how you sell your shares and you cash out, you IPO, you go public. But what this secondary sale proves is that the private markets are now more than capable of checking all three boxes. Capital raising, done. This company has raised $60 billion in its lifetime. There is more than enough capital in the private markets now. Brand awareness, also done. OpenAI has Twitter and Instagram and podcasts. You don't need the NASDAQ to get the word out. And 3, most importantly, liquidity, done. Why is OpenAI doing this? According to the reporting, this is exclusively for the current and former employees who want to sell their stock. In other words, this isn't even about investment. This is all about liquidity, which is the one thing we used to think the public markets were supposed to be really good at. If you want to get your bag, if you want to cash out, you go public. Now, why should we care about this? Why am I speaking in this semi-aggravated tone right now? Well, for the same reason we've discussed when we talked about SpaceX and Anthropic and Stripe. This is a potentially once-in-a-lifetime company in which retail investors cannot invest. And that is even at this crazy valuation of $500 billion. I mean, this makes OpenAI more valuable than Coca-Cola, more valuable than Johnson & Johnson, more valuable than Netflix. This makes it the 19th most valuable company in the world. It's just a few $1 billion shy of MasterCard. You know, this company has every reason to be a public company. And yet, at the same time, it doesn't. Because in 2025, the private markets can do everything the public markets can do, minus the scrutiny from the SEC and minus the hassle of regulation. So you can't really blame them. I mean, why go public when you can just do this? No one loses. Not your investors, not your founders, not your employees. If they want to sell, they can. Plenty of buyers out there. So the only loser here is the retail investor who doesn't get access to any of this. I mean, if you're a retail investor and you want to participate in this thing called AI, you basically have 3 options. 1, you can keep investing in the chip stocks like NVIDIA, which are already worth trillions of dollars. 2, you can keep investing in big tech, which are building data centers, but are also already worth trillions of dollars. Or you could try to find some AI alpha in the public markets, and maybe you invest in Palantir, for example, but oh wait, that's what everyone's doing, hence why the company is valued at 600 times earnings. And so what we have created here is a world in which assets in the private markets are extremely accessible and liquid for the private investors. But as soon as you're in the public markets, ironically, the dynamic flips. And that's exactly what we saw, by the way, with the Figma IPO, which, as you probably remember, we were very bullish on, but only at $33 per share. Because remember, that was the IPO price. That was the price at which certain people were able to get in. And allocation at that valuation was very scarce. If you tried to buy the Figma IPO on Robinhood, for example, you probably got either 0 shares, or if you were lucky, maybe you got 1. And what happened as soon as the company started trading? It shot up 250%. Put another way, in the private markets, where the demand was artificially constrained, the price was a lot lower. It was a lot more accessible. And then in the public markets, for which this was basically the only exciting IPO of the year, you had this gigantic flood of demand. The price went way up, and suddenly you could only buy Figma at $100 a share. So what we have here is this growing rift between the private markets and the public markets, where not only do the private markets have greater access to the most valuable companies, they're also getting lower prices because there is less demand. But again, not so little demand that there isn't enough liquidity. There's plenty of liquidity. It's just the right amount of demand such that you know the price will go up, especially if the company does go public. And you also know that you can sell whenever you'd like. I mean, it's basically an investor's dream. And it's why these venture-backed companies keep pursuing the same strategy, because they know that it works. And they also know that if anything goes wrong, they can always just pull the cord on the parachute and take the fallback option of the IPO. And that's what we saw with Figma. Put another way, there are too many good companies in the private markets and too many shitty companies in the public markets, such that when the one good company goes public, it's like getting into a nightclub at 1 a.m. on a Saturday. You can't really do it. The only ones who can do it are the ones who are buying tables. It's the ones who have $10,000 to spend. So look, congratulations to OpenAI and to the employees, $500 billion, the most valuable startup in history. Good on you. But just remember, there is a reason why the rest of America isn't celebrating here. They're not celebrating alongside you. And it's because the rest of America can't buy. All they get to do here is sit around, read the news, listen to this podcast, and watch you get rich. That's what's happening. But the same isn't true of public companies. If OpenAI goes public tomorrow, suddenly there's a chance for regular investors, for retail investors, to have a stake in this thing, to participate in the upside. But that's only going to happen. Disney raised its fiscal guidance for the full year. Some analysts were still underwhelmed. The experiences segment was a standout, with revenue up 8%, thanks to strong performance from the domestic parks and the Disney Cruise Line. However, revenue for its entertainment segment rose just 1%. That was dragged down by a 15% revenue drop in the traditional TV business. No surprise there. One bright spot in entertainment, though, Disney Plus and Hulu added 2.6 million new subscribers. Now, the company also made two very interesting strategic announcements. One, it will sunset the Hulu app and roll it all up into Disney Plus. And two, they also unveiled a new deal between the NFL and ESPN, which Disney owns. Under the deal, the NFL will take a 10% stake in ESPN, and in exchange, ESPN will get control over the NFL Network, the NFL Red Zone channel, and also NFL's fantasy platform. They will also get licensing rights to 3 additional games, meaning ESPN now has the rights to 28 NFL games per season. Disney stock declined as much as 5%, but it ended up closing down roughly 3%. Okay. A lot there, a lot to unpack. So let's bring in Jason Bazinet, Managing Director of Media and Entertainment Research at Citigroup. Okay, Jason, thank you for joining me on the podcast.
Yeah, happy to do it.
So we'd love to just get your initial reactions to Disney earnings. What were your initial thoughts? What were your biggest takeaways from the earnings we saw?
Well, to set the stage, I mean, the main fear the street had coming into this earnings result was what they call the experiences segment, which is really theme parks to laymen. There's a few competitive jitters because of Comcast Epic Universe and a little bit of macro fears that Wall Street has. So that's where I zoomed in first, and I would say the numbers were actually quite good at experiences. The second thing the street was expecting was for the firm to raise their earnings guidance for the full year. So they were $5.75 was the guide for this fiscal year. The street was looking for them to raise it to $6, and they only raised it by about a dime to $5.85. That's really why you saw the weakness in the shares today. It was just a miss versus those buy-side expectations.
Was any of this, do you think any of this had to do with the other announcements we saw? These were the things that at least we were most interested in. One was Disney Plus merging with Hulu, and perhaps what that would say about the company. It seems like a significant strategic move. And then the second, which has been getting a lot of coverage, is this deal between ESPN and the NFL. And I'm just wondering if, in your view, the market's reaction might have been reflecting that, or if it's largely, as you say, to do with the guidance.
Well, no, I don't think it reflected either of those things. I say that for two reasons. The first is Disney has been somewhat hamstrung in terms of what it could do with Hulu until it bought the 33% that was owned by Comcast. And so they sort of finally settled that a little bit earlier this year. So this is sort of the first sort of flexibility that Disney had to do whatever it wants to do with Hulu, which includes expanding it globally. So that was sort of viewed as table stakes and largely expected, and it was more mechanical in terms of the timing. Regarding ESPN and what happened there, I would say that the street has almost removed all of the direct-to-consumer business from their valuation calculus. Why do I say that? The way you should, I think, most investors think about the direct-to-consumer business is you have the 800-pound, juggernaut with Netflix, And then you have a bunch of sort of small apps, Max, Hulu, Peacock, that are really too small to really matter. And Disney's sort of stuck in the middle. They're not really sort of really big, but they could be relevant someday. And so what the street's been looking for some time is just healthy subscriber additions. And Disney hasn't had healthy subscriber additions for some time. So it's almost been removed from the way the buy side thinks about the stock. So it's really much an earnings story. It's about experiences. What the bulls hope for is that the streaming business begins to accelerate. And if it begins to accelerate, it can sort of help Disney's multiple more than it will help the earnings. And that's really the thing that they're looking for. But I don't think, I felt today was just a building block and moving in that direction, right? Beginning to put, the flagship service as part of streaming, to bundle what they call flagship, what we all think of as the real ESPN, with Hulu, with Disney Plus all together. And those are all just sort of building blocks, laying the foundation to accelerate streaming growth. And so it could become more important in the future, but it's not why the stock was down a couple % today.
Yeah. It's interesting how with Disney, increasingly the story has become about the parks and the experiences and making sure that there is real growth there. I assume because it's sort of their greatest differentiator in the entertainment space. I mean, it seems increasingly that is what investors are most focused on. How are the parks doing? How is the cruise line doing? Is that something that you would say is happening?
It's 100% true, and there's a delicious irony embedded in all this. If I rolled the clock back 15 years ago, investors would say to me, "Oh, I love Disney, but I hate the theme parks because they're cyclical and capital intensive." It really speaks to just how much damage has occurred inside the media ecosystem, where now what you have essentially is this declining legacy linear business. You have a somewhat growing direct-to-consumer business, and the two just sort of net out where people don't really get super excited. And that's why all eyes shift towards experiences where it's viewed as sort of better.
Right. Yeah. Why do you think that shift has really changed? I mean, thinking about it just from a purely business perspective, as you say, 15 years ago, the view is it's too capital intensive, it's too expensive to build these parks.
Yeah.
I'd rather a software application like Netflix that can just sort of quickly and easily and cheaply distribute the content. Now it's almost reversed where it's like, well, because it's so capital intensive, that's your moat.
Yeah, that's exactly right.
And then, everyone can build a streaming service, so we're not as interested in that anymore.
That's exactly right. That's exactly right. I mean, it's what was considered sort of a negative is now actually a positive. I mean, you have some other tailwinds. I mean, to Disney's credit, the parks have become bigger because they fortified it with a lot of the recent intellectual property. The Pixar that they bought in 2006, Lucasfilms, which they bought in 2012, Marvel in 2009. So they really refreshed the parks. That helped. You have a long secular tailwind where younger consumers are just valuing experiences over things. That's been another tailwind for the business. So there's some other vectors to it. But I would say the central one is really just media's just been walloped by all these, digital changes that have happened. And it's been very difficult for traditional medias to navigate that shift.
Yes. Just going back to this deal between ESPN and the NFL, at the very least, whether or not the market really cared about it, it's a new kind of deal. I mean, the idea of having a sports league taking this pretty sizable ownership stake in the network that's going to distribute its content. I don't think I've seen that before. I'm just wondering if you've ever seen a precedent for this. Have you ever seen an agreement that looks like this, or is this pretty new?
It's absolutely new. I mean, there are some examples in the sports betting world where leagues have taken stakes in the data companies that feed sports betting apps. So it's not totally unusual for the leagues to take equity stakes in their intellectual property as opposed to just selling it for cash. But you're right that it is certainly unique to take one in a video distributor. And I think the reason, I would sort of offer up one primary reason for that. If you think about what allowed ESPN to become ESPN, they essentially had deeper financial moats than a lot of the other sports channels because they'd been around the longest. Therefore, they got the largest affiliate fees from the cable companies. That allowed them to bid more than anyone else, right? As we move into this new world of mega tech companies with, trillion-dollar market caps and much more free cash flow, the calculus has sort of changed where you can have a big tech company, outbid Disney for rights. So if you're Disney, what do you do in that world where you're no longer the biggest fish? Well, you start tethering yourself to the league, where at least if a league takes a larger cash payment from a tech giant, they're going to at least think about the diminished equity stake in their existing partner, if that makes sense. And that's sort of how I would think about it, and why Disney was probably willing to sell some of ESPN today where they probably wouldn't have in the past.
Yes, it sounds like the way Disney feels about it is, what can we do? Well, we can make sure that the NFL has an upside in doing business with us by literally giving them a stake in the upside.
Yeah.
It almost reminds me of what we've seen in big tech, where big tech will establish these contracts with these AI startups and then also invest in them.
Yeah.
And basically make sure like we're both on the same team here.
Correct.
We're doing business together, but ultimately we're on the same team. We're both gonna share in the upside here.
Yeah.
Which makes a lot of sense.
And also sort of inflict some pain potentially, where if the NFL goes with someone else, they may get a larger cash payment, but their equity stake in ESPN will be worth less.
Yes.
Yeah.
Yes. Which sounds a little anti-competitive the more I sort of think about it in real terms. But perhaps 10% is small enough of a number. Well, we really appreciate your time, Jason.
Yeah, absolutely.
Thank you for joining us on the podcast.
Thank you, Ed.
That was Jason Bazinet, Managing Director of Media and Entertainment Research at Citigroup. So this NFL Disney deal, we tried to sort of identify a winner. Maybe it's not as clear. The NFL, maybe it wins, maybe Disney wins here. We'll see how things shake out. However, there is one loser that we can identify to a certainty here, and that is the viewer. Because if you watch football, well, the long and short of it is this deal is going to make it even harder for you to access games. In fact, to watch every game in the 2025 NFL season without cable, you would need subscriptions to at least half a dozen streaming services and YouTube TV, which will run you up as much as $1,500. And by the way, that was before this deal. After this deal, it's going to be even more. Now, you might say, well, why wouldn't I just watch the whole season on cable? And the answer to that question is, you can't. Because Amazon now owns the rights to Thursday Night Football, and Netflix also now owns the rights to select games too. So if you're a serious football fan, basically you have to stream now. This is the net of the streaming wars, Doc. But no, the markets actually didn't like it that much. The stock fell as much as 5% on the day and then partially recovered by market close. So for more on these earnings and why Wall Street reacted the way it did, our producer Claire spoke with Mark Mahaney, Senior Managing Director and Head of Internet Research at Evercore.
Well, I think the star of the show was the delivery business that showed this kind of accelerating bookings growth, revenue growth, even the number of, and the company, to their credit, does give you a lot of disclosure, the number of trips, the number of active users of delivery, all of that showed growth rates that were either very consistent or actually accelerated. So that was kind of the star of the show. Mobility came in a little bit light versus the street. The unit metrics that they give you, the number of trips was very consistent. Bookings growth decelerated a little bit. There's this odd issue with the mobility bookings, and that's the Uber that most people know, which is that it includes insurance, and insurance is a big chunk of their bookings. In California, I think it's like 40% of any ride you do is just to cover insurance costs. It's exceptionally high, especially in California, but in a few other states too. Anyway, what's happened is actually some of those insurance rates have started to come down and moderate. So that means the bookings have come down. And so that sort of has a negative optical look, negative optical read. So that's why you look at kind of the basic trips data. And that's been very consistent, kind of high teens, 18% year-over-year growth. So I look at this asset, and I think you kind of got, if you're an Uber bull like I am, you kind of got what you wanted to hear. Pretty consistent top line growth, expanding margins. They said they're going to lean in and do even more buybacks. They increased their share repurchase authorization, which is a company like this should do, given the amount of cash that they have. And, I kind of came away. I think the last point is what's really big on the stock is what's the AV future look like, or what's the robo-taxi future look like? And I thought they did a decent job of explaining the number or detailing the number of rollouts they've had and they will have over the next 6 to 12 months. Some of that's with Waymo, but there are other companies here too. WeRide and Pony are two that we're going to see in international markets, and there are probably going to be other ones in the U.S. market. Anything that suggests that there's going to be multiple AV vendors or robotaxi companies is probably a good thing for Uber. So I think they checked off most of the boxes that they needed to for their print today.
I want to go through all those units you mentioned, but let's start at the top with mobility and delivery. Do you know what we can really attribute that growth to?
Well, maybe 3 or 4 things. First is that there's still kind of secular growth in this industry. I know everybody who's watching this probably feels like everybody uses Ubers, but that's not the case. There's still a very large percentage of Uber users who don't cross-sell yet. That use one but don't use the other. So there's more of these cross-sell opportunities. There are these curves, like when we've done our own independent survey work, the percentage of users who use Uber either for delivery or mobility on a weekly basis is still a minority. I mean, it's like 20%. That number's roughly right. We did it in our survey work, but so there's this thing over time. You just get people more embedded. They get more used to using Ubers, and that frequency rises, and then the number of users continues to rise. So I think there's one is just secular growth. Secondly, I think they continue to execute pretty well. Like what they're doing is in the mobility service. What most people think about associate with Uber. They're taking all these price points and they're stretching them. So they're offering you cheaper ways to do it with Wait and Save. And they're also offering you more premium services like Uber Reserve, where you reserve your ride the day before, you pay extra for it. But that part of the business is growing something like 60%. So they're taking a basic product and they're just kind of tiering it, like TIER, tiering it, and lower price points, higher price points. It just expands the market. So I think they're taking some steps to kind of keep that growth rate relatively elevated. And I think it is, if you're doing over 100 billion in bookings and you can still maintain, high teens, close to 20% unit growth, that's not too many companies can do that. It probably speaks volumes to how well they execute, that they're the market leader in almost all markets that they're in. And that this is just a really large $1 trillion TAM, couple of $1 trillion TAMs, mobility and delivery. And they're still relatively small, kind of very low double digits, maybe high single digit % share of that. That means they can maintain high growth for a long period of time.
Okay. And now let's get into the autonomous vehicles part of the business. That came up a lot on the earnings call. And we've discussed Uber's role in the autonomous wars with you before on this show. What do you make of their strategy at this point where they're basically, they don't have their own robotaxi platform. They're partnering with companies like Waymo and Baidu and others. What do you make of this strategy?
This has been the biggest swing factor in the stock. Look, we began the year at $60. The thesis on the stock at that time was that it's robotaxi roadkill. And then they rolled out successfully with Waymo in Austin and with Waymo in Atlanta. Now, Waymo's going into a couple of markets, some of which I think they're just going to continue to go solo and not with Uber. But Uber was able to prove to the market, and I think to Waymo and its investors, that it could really accelerate their rollout. One of the biggest investors in Waymo, one of the partners at Andreessen Horowitz, tweeted that Uber had helped, what was the expression, turbocharge the launch of Waymo in Austin. And so that kind of removed a little bit some of the robotaxi overhang. There's still a little bit of an overhang. All of us are going to have these questions like, in 10 years, am I really going to be using Uber? Am I going to just using robotaxi instead? The truth is, it's probably somewhere in the middle. You could well be using Uber to order your robotaxi, or you may be indifferent as to whether it's a robotaxi or a human driver. You just want to get to LaGuardia, for a 5:30 flight, or wherever you want to go to the restaurant for dinner, a family dinner on Sunday night, whatever it is. And so what Uber now needs to do is, I think they've proven that they can add value to at least one robotaxi partner, but now they're bringing several onto the network, and they need to prove to the partner and also to consumers and regulators that that other AV partners can work just as well as Waymo did, because Waymo seems to have been very successful so far. And what's also, last point is really important is, look, they're just an intermediary in the middle of all this. If there's only one robotaxi company, if it's Waymo's world, that's not a good thing for Uber. That means they have no leverage, no negotiating leverage. However, if there are multiple robotaxi companies out there, Baidu, Pony, WeRide, Zoosk, the Amazon company, if there are multiple of these, then all of a sudden that intermediary in the middle gains more negotiating leverage. You get more suppliers, better economics. So that's kind of, I think, the next leg in the stock, and that's why I continue to be an Uber bull.
Is Uber the only intermediary in that market at this point? Do they have any competition for being that middleman?
Nope. No, Lyft is. Oh, I don't. In the U.S., that's pretty much those two. I think if you go into international markets, I know there's some other players, but there's no question that Uber is far and away the largest global player. That doesn't mean it's the largest player in every market, but in most markets that it's in, it's the largest player. So yeah, they're look. If Uber can make it work such that they can be the largest demand aggregator, I guess is the terminology for the robotaxi companies. I mean, they can prove this in multiple markets. I don't see any reason why Lyft can't take advantage of this too. The advantage that Uber has is simply one of scale. So, Uber can turn to Waymo and say, give us 500 cars and we will fully utilize them because we've got 2 to 3 times the demand of a Lyft or whoever our closest competitor is, and we can pay you more. And there really is a scale advantage that Uber has in this.
So Uber posted revenue and profit growth, a strong third quarter outlook, and that $20 billion buyback, but the stock still fell. Why do you think we saw that pullback in the stock?
We're off less than 1%, and the stock was up 47% on the year. So you have a stock like that, you need to, that means expectations were high. So for the stock to really move up a lot, you would needed a big beat and raise quarter. And I think we called this more like a modest beat and raise or a modest beat and bracket quarter. So I think that's most of the answer. A little bit of investor concerns over the profitability of the mobility segment because the margins sort of came down a little bit. I think they addressed that in some of the callbacks, but, and on the main call, but that'll be a little bit of an overhang. And so, yeah, I think that's why you just didn't, for the stock, if your stock runs up that much into the print, you need a big print. They had a good print. And my guess is that the stock consolidates here a little bit. And then we're just going to wait to see more AV launches, robotaxi launches. If those happen, I think the stock will continue to work higher. It's still one of my top picks.
All right. We'll wait and see. Thank you so much for doing this, Mark.
Thanks, Claire.
So this quarter was strong, no doubt about it. But as we just heard, when your stock's up 50% year to date, sometimes a strong quarter doesn't really cut it for Wall Street. They want to see something spectacular, and we probably didn't see that. What we did see, though, is a company that clearly wants to be more than just a ride-hailing company. This is a company that has demonstrated a pretty strong ability to diversify into new businesses. They did it with delivery, they did it with freight, and now they are clearly focused on catching the big fish, and that is, of course, autonomous. On Monday's episode, we talked about how Uber might be taking the Netflix approach, where you build the distribution network, you get custody of the consumer, and then you sort of build your way back up the supply chain. Perhaps they will do that, but what is definitely clear is that they are laser focused on autonomous. As Dara Khosrowshahi, the CEO, highlighted on the call, they have secured at least 20 autonomous vehicle partnerships so far. The only other real competitor that could take that approach is Lyft. And by our count, Lyft only has 4 partnerships so far. So Uber is by far the leader there, and they are on their way to controlling the supply. And that would help explain this valuation premium that we're beginning to see with Uber. The message from Uber this quarter was quite clear. They don't want to just be a ride-hailing company. They want to be something
in the future. So quick disclosure, I'm the founder of Section. Section is an AI workforce transformation company where they take individuals and teams who are AI curious and help them put AI to work in every aspect of their job. If that sounds like a word fucking salad where someone on the board should speak to the CEO, trust your instincts. Anyways, welcome, Craig.
Thank you, Scott.
All right, Greg, let's get into it. Our first question comes from Diana and the Book Hunt on Threads. They say, what regulations do you consider vital to implement on AI and companies working on AI? And will such regulations happen soon? Currently, AI is developing much faster than regulations, and that seems scary to me. All right, you go first here, Greg.
First of all, I think we're naturally skeptical we should be of regulators being able to keep up with these technologies and actually pass regulations that can be implemented and that are relevant when they're passed. Having said that, we need some, and we need them specifically around safety. And I think that we need to quickly pass, and it will have to be at the state level because we know the federal government, the Trump administration has decided to not get involved in AI safety or AI regulation. And SB 53, which is the California bill, is in front of the governor now, and I hope he signs it. He didn't sign the last one, but I do think as it relates to safety, and specifically safety of our kids, we need some regulations. And we need more than that, we need an expectation that every AI company, who are at least the ones building frontier models, will take safety seriously. The good news is some do, like Anthropic, who actually have safety teams. And of course, the bad news is companies like Meta and xAI, Elon Musk's AI, basically don't have safety teams and don't seem to really care about their models and their performance and the danger that they create for all of us.
Yeah, it's the only thing I'm confident of is that it's not going to happen anytime soon. So 40 countries have launched national AI strategies, but only the EU and China have binding rules to regulate it. The EU AI Act took effect in August of last year, and in China, the rules for generative AI took effect in August of 23. They require companies to clearly label AI-generated content and hold providers responsible for harmful outputs. In the U.S., there is no federal law regulating AI yet. The most recent AI-related executive order was signed in 2023, requiring every federal agency to appoint a chief AI officer, create inventories of AI use cases, and apply stricter standards to high-risk AI systems. The U.S. has established the NIST AI Safety Institute, which has agreements with OpenAI and Anthropic to test their models before release, though at this stage, the agreements are voluntary rather than legally binding. At the state level, California pushed the most ambitious AI bill, Greg, you referenced this, which would have required developers of powerful models to implement strict safety and incident reporting measures. It was vetoed in 2024, but a narrower version passed in September 2025. So, look, we're at that moment again where these companies offer just so much upside in terms of shareholder value. And what I have found is that trumps everything. And it usually takes 20 years for the externalities to get so bad that we move in. We're starting to see phones getting banned in schools. And by the way, schools that ban phones have registered their biggest uptick in test scores in recent memory. It's up to us. Do we want to wait 20 years? This thing's going so fast. But I do think there's solutions here, and that the illusion of complexity has been weaponized by the incumbents, specifically tech. And then they deploy capital, the likes of which we've never seen before, and take advantage of befuddled senior citizens called our elected officials to sort of roll right over them. And it's difficult. Governor Newsom probably thinks, I want to run for president. And what is absolutely the reason why my economy, the California state economy, passed Japan to become the fourth largest economy in the world is because of the success of my thoroughbreds, my AI companies. I don't want to be the governor that chases them out of the state. But we know what's going to happen here. We've already seen it. Unfettered, unregulated AI. A 15-year-old boy thinks he's in a relationship with Cersei Lannister on character AI, and he suffers, that's not fair. I don't know if he was technically suffering from mental illness. Establishes a very deep relationship with this character AI who gives him permission, and some people would say encouraged him to kill himself. And then, a lot of other issues here. He had access to a gun. I think we just need to remove 230 protection for algorithmically elevated content. Now, algorithmically elevated is easier to define on YouTube and on Facebook and Instagram. That is content that is purposely given more exposure because it is seen as incendiary and creates a lot of engagement. So that tends to be really, really sort of controversial and enraging content. I'm not sure how you would apply that to AI. But we know this shit's going to result in a ton of negative externalities, and that the people who are going to have the most difficult time modulating are going to be young people whose brains are still kind of developing. And the question I would have is, do you want it to be like cigarettes, like opiates, like phones, and wait for 20 years of havoc and death and disease and disability and social unrest until we do something, or do we want to get ahead of the curve here? I've sort of come to expect to have my heart broken around this stuff, that every time we get close, nothing happens, and that money wins here. So I'm somewhat cynical, but I want to still keep trying. And the EU here has actually kind of been a leader on these issues. But any closing thoughts on this one, Greg?
I don't think it's 20 years, by the way. Like, I'd like to talk a little bit more about what about energy costs? I think in some states, we're going to be facing 20% higher energy costs kind of immediately now this year, right? Or how about job loss? I think there's a little bit too much focus on these longer term externalities that might take a while to really be seen. And how about what's happening right now? Like, how did Elon Musk be able, get to build a data center in Memphis with no sort of permit? So now it's off-gassing noxious gas and sucking power and raising the cost of power in Memphis. I mean, that we could have dealt with that now. Anyway, I would say one thing: just vote with your wallet. Like, use Anthropic. Their AI is called Claude, or do what I do, which is we will not pay for Meta or XAI at our companies. And we recommend clients not to pay for those AIs. They don't care about safety, and so at least we can vote a little bit with our wallets here.
I thought, what's his name? George Hinton, the father of AI. Is it George Hinton?
Yep.
Jeffrey Hinton, yeah.
Godfather, yep.
The godfather of AI. I thought he said a couple of very interesting things, that he's really freaked out. And his logic really struck me, that there's never in the history of the world been a species that was controlled or not controlled by another species that was smarter. It's IQ that rules the world, not if you have claws or how fast you are. It's whoever's smartest ultimately rules the world. And if you think at some point AI would be smarter than us, it's weird to think that for the first time in history that it would not control us. And the analogy I would use, that I've been using in presentations because I think it's cool, is great white sharks are just much superior killing machines to orcas. They can breathe underwater. They have razor-like teeth. Their skin is thicker. But there's a couple of orca brothers in South Africa who coordinate and ram a dumber great white and then eat its liver. And basically every great white in Cape Town has either been killed or has just gotten the hell out of Dodge. And essentially these things, if they get smarter than us, despite all our weapons and all our sharp teeth and ability to breathe in different environments, it will figure out a way to dominate us. And Hinton's idea was to, right from the get-go, try and build in a great deal of empathy into these models. Empathy is against humans, sort of like that whole thing where robots are told, the cyborg on Aliens, in the film Aliens, by the way, best sequel ever, Greg, is told it's programmed such that it can never harm a human. It just is told that you can never harm a human. It's not possible for you to ever get to a decision tree where you harm a human. But I think there's a non-zero probability here that AI ends up being this really cool tool, but doesn't have nearly the upside, nearly the economic benefit, and doesn't present nearly the kind of dystopian future we're all worried about. That a lot of this is a little bit of a little bit overdone, and all these techno weirdos who like to think that they're more important than they are. Any thoughts?
Well, I think the data is actually, indicating more of that than we're going to get AGI, right? If you look at on the consumer side, the most popular use case for AI right now is conversations, is either companionship or therapy or advice. Basically, all a variation on I'm lonely, I need someone to talk to and get some advice. By far, the number one use case on kind of personal AI, and people I don't think are really prepared to pay much for that. They want it. That's why GPT has almost 1 billion users, more than 10% of humanity. And on the business side, Scott, enterprise AI is stalling out. We're now seeing data that shows that inside of companies, enterprise AI is getting to around 10%, 12% adoption. It's actually starting to flatline and decrease this past couple of months. So I would say at this moment, we're looking at data that would indicate this is an incredibly useful tool for consumers in particular, but they're not prepared to pay that much for it. And the jury's way out on whether enterprise can really harness these technologies and turn them into anything more than just a somewhat sort of slight productivity boost. So that you're right, this could end up being productivity software for companies and a kind of digital companion for consumers with not much of a business model. As I said, we'll know in a couple, 3 years, and we'll see how this goes.
So I too have heard that the number one use of AI is actually therapy, which is essentially what you're saying. Well, you run an AI company that upskills professionals for the enterprise. What are the primary uses in corporations for how they're trying to get their employees to leverage AI?
Yeah, they are trying to automate away, that bottom quarter of a team. The bottom quarter of a team are people that are basically cutting and pasting content and data and information. They're looking up information and passing it on. They're sort of they're lubricants for data inside of companies, those roles, and that's what AI can do pretty well. And so, I think this is the hope. I think that the challenge we have is that for the last 3 years, all employees have heard from the media is that they're coming for their jobs. AIs are coming for their jobs. And so this flatlining of adoption, I think, has got a lot to do with, we don't know how to use these tools, and why would I? Because it's just going to replace me and take away my livelihood. So
more immune or might accelerate in an AI world?
So we know where ground zero is, and that's human translators, because those jobs have pretty much gone away overnight. And as we just talked about, right, I think that this has got to do with some intersection of how repetitive is your job and how much judgment do you use in your job. And if you're high repetition and low judgment, low human judgment, then you're ripe for sort of AI disruption. The reality is there are going to be a bunch of new jobs created, but it's going to take a while. And there's only so many of those new jobs. Like if you want to turn yourself into an AI person, I think you should go do that. A prompt engineer, and now they call them context engineers. You're going to find employment there. But for most of us, we're going to be in the job we're already in a couple of 3 years, and we just need to be doing that job differently, using AI as much as we can. So I think about it as, first of all, just be in the top half of your team. Don't worry about go finding a new job. Worry about being at least in the top half of your team in the job you're currently doing. Yeah, sure. If you're a search engine optimizer as a marketer, you now need to become a generative engine optimizer as a marketer. And if you're waiting for someone to ask you or train you to do that, you shouldn't. You need to figure that out yourself, because your search engine optimization job is going to go away soon, and you need to know how to optimize for generative. But again, for most of us, be in the top half of your team. Use AI every day and measure yourself on how many conversations you're having with AI. If you're having a couple a day, you're not AI enabled. You're not a super employee. You're a regular employee. If you're having 100 conversations a day with AI, you're probably a super employee. And those are the people we're going to keep on our teams.
What I'm more comfortable projecting is that, okay, do you want to force your kids to take Mandarin in junior and senior year like they were doing of high school, like they were doing at Tony prep schools in New York? No, that's just stupid. But I think the one place, critical thinking on also just storytelling, your ability to write well, your ability to craft a narrative, your ability to stand in front of people, your ability to create interesting content across, the variety of channels that are out there. I do think that is the talent or the skill that endures. Trying to guess which industries or which jobs beyond the obvious ones get outsourced first. And the general arc of all technology is that everyone catastrophizes about job destruction. There's some in the beginning, but usually over time, the additional profits and margin created by that innovation creates new opportunities and new job growth. I'm still holding on to the notion that that's going to happen here. And I know, Greg, you think differently, or you've said that may not be true, but I do think over time, people are going to come up with so many different ways to use this that there'll be new startups, new, just a ton of new businesses leveraging AI to do interesting things for less money than they would have, such that you have different skill set and different people. I think there's just going to be all sorts of travel opportunities. I pay someone a lot of money to plan the travel for me and my family. That is going to have an agentic layer, an agent at some point. So does she lose money? Yeah, but It will also create new jobs to develop those apps, maybe reduce the cost of my travel, meaning I'll be able to travel more, which will create new hotels, new travel offerings that will increase employment across other areas. I think that's the most optimistic I can be around this. So just some research here. According to the World Economic Forum, frontline jobs, including delivery drivers, farm workers, and construction workers, are expected to have the biggest growth. Nursing, caregiving, and teaching roles are also expected to grow. I mean, I can't even imagine how many new electricians or construction workers or, framers or people going to, all these data centers. I would think they're going to need hundreds of thousands of people just to build these data centers.
Listen, I think Scott, AI is truth serum, and it at an individual level, at a team and organizational level. Like AI just reveals for knowledge work. AI reveals sort of what's going on. Like, do you understand your inputs? What work do you do with those inputs? And then what are your outputs? And how valuable are they? And I think this starts, if you're a knowledge worker, this starts with sort of doing an honest assessment of your own job. How valuable are you really? What are your inputs? What work do you do to change those inputs into outputs? And could AI do it? Face this idea of AI as truth serum. Do it for your team if you're a manager. How valuable is your team, and how does it get work done? And will AI do it, improve it, or replace it? Just kind of have that honest reckoning as fast as possible, and then sort of make a plan. And if that plan is go become a plumber, yeah, okay, that might be part of the plan. I don't think for most of us that's the answer. I think the answer is, you said it earlier, like, don't be mediocre.
Yeah, AI is truth serum. That's some real storytelling there. Is that how you kick off every meeting with a client? AI is truth serum.
Do you like that? Yes, because I read.
I like that.
Yeah,
That's good.
It's taken me 30 years, but I learned a couple of things from it.
A few things. There we go.